Welcome to episode 52 of the Cash Flow Connections podcast. Our topic for today is getting your money out of the banking sector through whole life insurance. Now, you may have heard of something called the infinite banking concept. In fact, we've had a guest on the program before to discuss it. It's something that keeps coming up in a lot of different angles, all from people I have a lot of respect for, but I just haven't really been able to get over the hump completely yet. So I decided to get someone on the program who is definitely considered a thought leader in the sector to basically get to the source of a lot of the interest that's taking place right now. Additionally, I have a similar perspective on a lot of things to our guest, particularly as it relates to economics, so I thought it would make for an interesting discussion. So in this episode, we're going to discuss, first of all, why you should remotely be interested in getting your money out of the banking system. This is something that a lot of people take for granted, I think for relatively good reason. The US is a first world country. All deposits of $250,000 or less, they're insured by the federal government. But our guest points out a lot of things that may surprise you here, and I think they're actually quite valid in terms of some of the underlying risks of the banking sector. And this is actually a great segue into another topic we discussed, which is whether or not life insurance companies are more stable than banks. Because obviously it's important to weigh those two if you're thinking about moving your money out of the banking sector and into the whole life insurance policy. We're also going to talk about the typical mantra that's repeated over and over again, which is buy term and invest the difference rather than investing in whole life. This is repeated by thought leaders like Gordon Ramsay, for example, that are a big proponent of investing in life insurance if you need life insurance and not investing in whole life insurance. And we go into some of the reasons that he's kind of on the other side of that fence. And we're also going to talk about how the IBC strategy compares to typical self-directed retirement accounts, particularly the cream of the crop accounts like the self-directed solo Ks with the Roth component. I think that that's one of the things that this particular industry hasn't really accounted for yet. Really, the pitch is, look, get your money out of banks. Well, someone like me, I don't have a lot of money in banks, right? I'm always trying to recycle cash flow into new investment opportunities. But I think even then, there is something to take away from this IBC strategy. Like I said, I'm not an expert in this. I'm still learning. I learned a lot during this podcast. So again, I thank you for the opportunity to do that, but just keep that in mind as you're going through this and as you're thinking it through with me. And of course, we're going to talk about some of the risks of the IBC strategy, best practices, ways you can really protect yourself, ways you can make mistakes and make this not work out for you, things like that. And we really do pretty much jump right into it. We do define some terms up front, but if you still feel like you're getting lost, I would suggest going back and listening to episode 15. This is where we cover some of the basics. Now, in this interview, I was even less knowledgeable about the topic, so you're kind of hearing me think it through during the interview, but I think it'll be helpful for a lot of you if you're just getting started on this topic. And of course, I will link to that in the show notes page. Also, I can tell by the download numbers that we have gotten a significant amount of new listeners over the last few months. So if you've enjoyed a few podcasts, really like the content, make sure to leave us a review in iTunes. This is actually one of the most important factors when it comes to ranking in iTunes, but more importantly, it really helps our ability to get high quality guests. As you probably assume, the first thing that people do when they hear about the podcast, they look at the numbers of reviews. Even if it's subconscious, that's the first thing that they pay attention to. Now, I know a lot of you are busy people, investors, etc. Leaving a review, it's very easy. It probably takes about 2 minutes max. So if you haven't yet, make sure to go to the podcast app in iTunes, search for the Cash Flow Connections Real Estate Podcast, and leave an honest review, hopefully a 5-star review. If you just screenshot it and send it to me, you can email it to me at info@cashflowconnections.com. I will thank you, number one, and I will also make sure that you have our 2 commercial real estate ebooks. Again, probably takes 2 minutes, and it makes a huge difference. Just the difference between having 85 reviews and having 150 reviews is a major, major shift when it comes to attracting new listeners. So if you're enjoying the content, make sure to leave one. All right, enjoy the episode. How's it going, everyone? Our guest for today is Robert Murphy, who is a co-creator of the IBC Practitioner Program. He also has a Ph.D. in economics from NYU, and he is a senior economist with the Institute of Energy Research, a senior fellow with the Fraser Institute and the Mises Institute, and a research fellow for the Independent Institute. He has testified before Congress on energy markets and monetary policy and has given numerous interviews on TV and radio. He is also the author of hundreds of articles and several books on economic topics aimed at the layperson, and he publishes the Laura Murphy Report with Carlos Lara. All right, Bob, it's obviously an honor to have you on the program today. Going to talk about an interesting topic, so thanks again for coming on.
Glad to do it. Thanks for inviting me.
So the topic for today is really this concept of, infinite banking. This is something that it's been around for a long time, but I think recently with the publishing the books regarding Nelson Nash, and there's really been a resurgence of this, is my opinion at least, being involved in financial matters. Before, we've had someone talk about the big picture of what this whole life policy is and how it really can affect your finances. But before we jump into that, let's talk about why this is important. Why is this conversation important to have? Why should people be listening to this in terms of, getting their money out of the banking system in the first place?
Well, you're right that this is, in a sense, what infinite banking does is it allows you to have like a cash flow management system using whole life insurance policies that are designed in a particular way. And so you're right, the features, whole life insurance, that's really old as conventional, boring, if you will, financial product. But Nelson Nash, the inventor of IBC, the infinite banking concept, he realized, wait a minute, you can use it in a certain way to, quote, become your own banker. So the way Nelson thinks about it is he's saying that you're allowed to take control of your financial destiny, that you don't want to be dependent on outside lenders to, when you want to get a car, your daughter's getting married, when you want to buy a house, that the way most Americans right now run their finances, they, earn their paychecks, they put a certain amount away for retirement in a tax qualified plan. They can't touch that money until they're 59 and a half or whatever the particular rules are. And then when they have to buy something big, they got to go borrow it from conventional lenders. And Nelson's point was that is a system where you're utterly dependent on other people. And also, depending on how you run the numbers, you're throwing away a lot of interest expenses as opposed to saving up yourself on your own, putting it in your own vehicle where you can become your own banker, in his phrase. So I think in terms of financial independence, and that's really the big element of it that's true in any environment. But in our particular circumstances, ever since 2008, I would say, armed with my knowledge of Austrian economics, I think the Fed has set us up for another major crash. And so that's all the more reason that the typical places that financial advisors are going to have you storing your wealth, I think, are pretty vulnerable. And so beyond just the general virtue of controlling your own cash flow system, I think you don't want to be exposed to a lot of the places that are vulnerable in the upcoming times.
It makes sense. And I'm definitely looking forward to getting your perspective on not only IBC, but also kind of the state of the economy as a whole. So I think that a good way to start this conversation is to define some terms and really give people a big picture understanding of really what the difference is between this term insurance, which maybe more people may be more familiar with, versus whole life, and some of the benefits of whole life, as well as this, cash value and potential loans you can take with your policy with the cash as kind of the collateral. Could you kind of walk us through those couple of terms and how those can be maneuvered?
Sure thing. And I should just mention for your listeners that this is an area where I came out of NYU. I had a Ph.D. in economics. I was in academia. And when I was first exposed to Nelson Nash's booklet, I didn't really understand it either because I didn't really know what whole life insurance was. I didn't know the difference. So, this is by no means something that everybody should, would automatically know. So yeah, term life insurance, it's, as the name suggests, you only have it for a certain term. So you might get like a 20-year policy. And in that case, let's say you're 25 years old and the contract between you and the life insurance company is you're going to pay set premiums for 20 years. And as long as you keep paying them, they agree to give a death benefit to the named beneficiary. But after that 20 years is up, once you turn 45 in this example, the contract, expires. If you're still alive, then that means you paid in for those 20 years. They never paid you a cent. And then that's it. And you go your separate ways. It's like you're renting the insurance coverage, the life insurance coverage. It's similar to, automobile collision insurance or fire insurance on your house. You're paying for the peace of mind to know if there is a catastrophe, they're going to make you whole. But it's not like you're building equity in that policy. In contrast, a whole life insurance policy says that as long as they calibrate the numbers, and so the premium you're paying there keeps the policy in force, and you have the option of continuing it indefinitely, either until you die or until you reach some large age like 121, at which point the policy matures. So the difference is the life insurance company knows as long as you keep that policy in force, they're going to have to pay you eventually. Whereas with the most term policies expire without the life insurance company having paid out on it. And so, because as you get older, if you try to apply for a term policy, it gets more and more expensive, obviously because the actuaries are telling them you're more likely to die the older you get. And so at some point, if you're just doing normal term policies, probably you're going to decide it's not worth it anymore. So you would normally let that lapse. But with the whole life policy, like as I say, the way those are structured contractually by their very nature, they're supposed to be in place for your whole life. So yeah, the premium's higher for a given amount of death benefit coverage, but that's because it's effectively, depending on how old you are, like a 80-year term policy, if you want to think of it that way, because it's lasting until you're past 100 years old. So that's the nature of it. And with a whole life policy, you effectively build equity in it because they're charging you more on the front end, if this is the way you want to think about it. Since they're charging you a fixed premium for your whole life, then in a sense, they're charging you more than the pure insurance coverage needs to be on the front end. And then they're putting that money to work. They're buying assets. They're accumulating assets, in a sense, backing up your policy. Because each year that passes, if you have a whole life policy, that becomes more and more of a financial liability to the life insurance company, because they know, statistically speaking, you're going to die. You're more likely to die as you get older. And so the present value, actuarially discounted and taking account the time value of money, to them, of that liability keeps growing over time. But they're getting premium payments from you, and they're buying assets, to help cover the cost in case you die. And so that's what gives rise to what's called the cash surrender value. So that, it's like I say, you're in a sense building equity in this policy, and that at any time, if you want to walk away and collapse or surrender a whole life policy, they will pay you a flat amount for you to walk away. And that's what's called the cash surrender value. So you wouldn't, with other types of insurance, you wouldn't have that. It's not like if you say to the car insurance company, hey, you know what? I got rid of my car. I don't need this policy anymore for collision. So can you go ahead and send me a check for $18,000 because now you're not in the hook? They would say, what are you talking about? The premiums we were charging you, that was covering you for the term. You don't want the policy anymore. Okay, but we don't owe you money. It's not like that when it comes to whole life insurance because, again, just the nature of it. So those are the big differences. I guess I'll stop there because I threw a lot of information. The other component's a policy loan, but I'll stop and give you a chance in case I missed something for your listeners there.
Yeah, thanks for kind of going through that. So I think that the term insurance thing, I think that's clear. I think that a lot of people are going to be familiar with that. So one of the main differences, obviously, with whole life is it does insure you for your whole life, meaning that there will be a payout if you continue to pay the premium on a regular basis, as you contractually agreed. But the key, and one of the things that really makes the differential here is that you're actually building up equity every time you pay down your loan or pay down the policy, and that cash value increases. And so the cash value later can be used as collateral, which is where the policy loans come in. So why don't you briefly discuss what the policy loans and how this plays into the increasing cash value as the term is paid?
Sure. And maybe I'll use an analogy just for your listeners who've never heard this concept before. This often makes it click for people who are financially savvy, and especially since you've got a lot of real estate investors. An analogy that's often used is to say, imagine you have a piece of property and you've got a mortgage against it. And so every time you make a mortgage payment, the equity you have in the property goes up. And likewise, with a whole life policy, just think about it that if you keep that thing in force, there's this looming death benefit that's in the future that with the passage of time gets closer and closer. Of course, it's actuarially distributed in terms of probabilities. They don't know exactly when you're going to die, but they know statistically you're going to at some point. And so if that's the amount they owe you, then what's the lien against there? What's offsetting it is the remaining stream of premium payments that you have to make to them. And so if you think about it, again, the liability going forward to the insurance company keeps increasing every time you make a premium payment, more time passes, because the death benefit they're going to pay you, that gets closer in time. And so, the present value of that grows. And then they have one fewer premium payment that you're giving to them to offset that. And so that's why the net equity that you have in the policy grows over time. So it's like the moment you take the policy out, it's got a value of zero, right?
Mm-hmm.
The future stream of premium payments is just going to offset the death benefit, competitive markets, that kind of stuff. And then with every premium payment you make on net now, you have more and more equity. So that's why the equity grows over time, and that's what's called the cash surrender value. Just like the equity you have in a house would tend to grow over time every time you make a mortgage payment. So there's that element. And now, so one way you can get access to that is if you just literally surrendered the policy, they'd give you the money, you'd walk away, and your life insurance with them would be done. But there's another option, and this is all contractually guaranteed when you sign up for the policy, is that you can take out what's called a policy loan. So here, it's the life insurance company is giving you a loan on the side, as it were, but the cash surrender value in your policy is the collateral on the loan. And so because of that, that makes the life insurance company willing to grant the loan on very generous terms. So specifically, they don't ask you, what your income is. They don't run a credit report. They don't ask you what you're going to use the money for. And they don't even insist on a specific payback schedule. Whereas, you go get a home equity loan, they're going to do all those things. And again, the reason is the life insurance company, when it gives you a policy loan, it itself is guaranteeing the collateral because, again, it's your cash surrender value. So for just to give example, let's say you had $200,000 in cash value in a policy and it was $1 million death benefit. They would let you take out a loan up to $200,000, rolling over, let's say at 5% interest. And so if you took out a loan for $150,000 and then let's say you didn't pay anything on it and then you died next week, you got hit by a bus. Well, they owe you $1 million, the death benefit, your beneficiary, but they would first pay themselves back the $150,000 loan. Okay, or if you hadn't paid anything and the interest was accruing, they would pay themselves back whatever the total amount was because of your loan and the accrued interest. So that's why they're very flexible because they know they're getting paid back. They just don't know when. Either you're going to literally just pay the loan back yourself, or you're going to surrender the policy, in which case they go to give you the surrender value, but then they pay themselves back. Or you die, in which case, again, before that death benefit check goes out the door, they first pay themselves back. So that's the basic structure of how these things work. And that's been in place for a long time. And it was Nelson Nash, though, who realized, wait a minute, with that infrastructure, with that mechanism, you can build yourself a nice little cash flow management system, or what he called your own personal bank, in quotation marks, because it's not legally a bank, but just a way to have money coming in and out that you can control.
Got it. And just so, you may use some terms that you are not comfortable with, but let's just say for the sake of a metaphor or example, let's say you put, $500,000 representing your cash value, $500,000 in a checking account. That bank may very well lend you up to $500,000 because they understand they have your $500,000 as collateral. They're not worried about lending you that money back to you. They're in a really good position. It's a very low risk loan for them. Is that a fair kind of metaphor for what you just explained?
Well, it might be. Yeah, that's fine. Or another way of thinking of it would be, if you had a house that was free and clear and it was worth $300,000, you took out a home equity loan. Yeah, what the bank is doing is giving you a loan with that serving as collateral. So here, then again, it's just the life insurance company is giving you the loan. So I want to be clear, they're not taking the money out of your policy. Just like, if you get a home equity loan, it's not like they're literally digging up your porch or something.
They're not taking your house. Yeah. Got it.
They're knocking down walls. The asset is just serving as collateral. So it's the same thing with the life insurance. But you're right that why your analogy is probably more analogous is here in this case, there's the life insurance company is not worried at all about the value of the collateral. Whereas with the real estate home equity loan, even if it looks like it's super collateralized, the market could crash. So they might have, at the time when they granted the home equity loan, it might have been, only 20% of the home's value. But if things were, are terrible, they could end up with you owing them money. And even if they foreclose and seize the property, they still can't pay themselves back. Whereas that can't happen with the life insurance company because they themselves are guaranteeing the collateral. They owe you more money than the policy loan that you owe them, just depending on when you trigger the scenarios that trigger that payoff.
Okay, got it. Now, I'd like to move into some of the reasons why this is advantageous. But before I do, I would need to ask the one question that is usually the first question that people ask, or even a statement they say when I bring this up. So, does this structure that we're going to talk about today only make sense if you really need life insurance?
Uh, it certainly makes a lot more sense if you need life insurance. And I guess I would say that it would be hard for me to answer that as a blanket rule because, everybody's situation is different.
Sure, definitely.
I would say it would be hard for you to come up with a scenario for me with someone who doesn't want any life insurance because even if it's like, I'm not married, I don't have kids. I mean, still, unless you're planning on consuming all of your wealth and dying with, being worth exactly $0, this is still a good way to transfer assets to your estate. You know what I'm saying? Like the beneficiary you can name, in other words, can just be your estate. So I would just remind people of that this is a way. It has certain tax advantages too, like to give money income tax free to a named beneficiary, again, which could be your estate. So it's not merely if you have dependents or something, or you're worried about leaving somebody who's got to pay off a house. That just in general, if you're planning on having some assets that are going to get distributed to philanthropic causes or what have you, you could do it this way.
Got it. And I do appreciate the clarification there, because an important part of this conversation are those tax advantages, which you were just alluding to, which we'll talk about later, I'm sure. So there's been some changes. You mentioned since 2008 in particular. Talk us through what happened in 2008 or the subsequent years thereafter that really made this conversation even more important than it was, let's say, 30 years ago, particularly as it relates to the Dodd-Frank Act.
Okay, sure. Yeah. So there's two main avenues that my co-author, Carlos Lar, and I have been hitting. And I should just say this officially. Carlos and I are pretty joined at the hip in the stuff that we do on this. So I'm not including, Nelson is the developer of IBC, but I don't want your listeners to think that everything I say from this point forward is something that Nelson necessarily agrees. So I'm just protecting him in case for my possible
Makes sense.
Or my misforecast about the economy. So yeah, the things that Carlos and I have been worried about are two main things: is the Federal Reserve's actions, and then, as you say, the Dodd-Frank regulations. Just very quickly, as far as what the Fed's been doing, we subscribe to Austrian business cycle theory, after named after the Austrian School of Economics. And so we think that the boom-bust cycle in market economies is driven by when the government, in league with the commercial banks, pushes interest rates artificially low. That causes a false boom. And then when they let interest rates rise, that leads to a bust. So that's our basic framework. And we think that's what helped fuel the housing bubble and then the crash and led to the financial crisis. And then, what the Fed did from 2008 forward was like what Greenspan did after the dot-com crash, except, times 10 or whatever factor you want to use. So we think that the economy, has had massive asset bubbles blown up, and we expect as the Fed continues to tighten, we are going to see a bad crash at some point. So that's one reason that we think people should really look at this even more so than in normal times, is just because a lot of the conventional outlets for wealth we think might be overvalued. As far as Dodd-Frank, so as your listeners know, that was a major overhaul. The thing that Carlos in particular, he literally went through and started reading the thing. I joke that not even the people who voted on it read the thing. Carlos has a lot of experience working with troubled business owners and then trying to keep them out of bankruptcy. So he knows bankruptcy law. And he was saying that, there's portions of this Dodd-Frank Act that they're talking about the liquidation process for a failed commercial bank. And he's saying what they did is they realized how angry the public was after the bailouts of 2008. The public was angry and could see that, these rich guys who made stupid loans or made bad investments during the housing bubble years, they're getting bailed out. Whereas, normal people are getting foreclosed on and kicked out of their houses. What the heck? And so he's noticed that they had provisions for what we could call a bail-in, whereas they're not going to use taxpayer money the next time a crisis hits and there's major bank failures. Besides FDIC, they're not going to kick in additional tax dollars to rescue banks. And instead, what they're going to do is, if a bank goes under, they're going to come in, shut it down, and then the liquidation process, to the extent that the bank is underwater, they're going to make the creditors eat the loss. And the point is, when it comes to a commercial bank, one of the major class of creditors are the depositors. And so, just warning people that leaving your money in a commercial bank is a lot riskier now than it used to be, because they literally have, mechanisms in place that if the bank goes under, you're not going to be made whole. And they did test runs of this. This isn't just science fiction or something. This, they did it like in Cyprus, for example, where they had cases like this, and around the world they've done things where they sort of gave people major depositors, they gave them haircuts and so, or they gave them stock in a defunct bank instead of just giving them the money back. So he was just explaining that they have laid the foundation for that already. So that's really in place, so that the next time a crisis hits, things are going to be handled differently. Because what happened in 2008, the government and the Fed basically came in and just told everyone, "Don't worry, we're backing everything up. Don't panic." And Carlos is saying that he thinks the way they've set things up now is that the next time a crisis hits, they're not going to say we're backing everybody up. They're going to just try to do structured bankruptcy proceedings, which I think makes more sense, like legally and economically, that you shouldn't be bailing people out with taxpayer funds instead. But just to say, for people who kind of think, oh yeah, when you put your money in a commercial bank, it's totally safe, that's no longer true.
Yeah, and even to kind of further that, I think that a lot of people, like the common argument at least, is that the FDIC insures deposits up to $250,000. So, you could hear people that say, well, look, I have 5 accounts. Each one has no more than $250,000. So I'm perfectly secured by the FDIC. What are your thoughts on that strategy as it relates to this conversation?
Well, right. And that kind of underscores, again, what the whole reason they put FDIC in place in the 30s was because there had been all those bank runs in the early 30s. And it sort of underscores that the nature of modern commercial banking is fundamentally flawed, I would argue, because of what's called fractional reserve banking, where your listeners know this. You give $1,000 to put in your checking account. They don't just put that in a vault with your name on it. They go ahead and lend out most of it, at least in normal times. So that's why commercial banks are always vulnerable to a bank run, and just by the nature of their business. So the point of FDIC is to get the public to not really care what their bank does with the money. The point of FDIC is to reassure people and say, no, don't worry about it. If you think your bank has made some bad loans, don't go run and try to get your money out, right? So the problem of what that does is, that might solve the immediate problem of bank runs, but then it leads to a moral hazard problem where now, people who open up checking accounts, they look to see like, oh, what are you going to charge me, for overdraft fees, or what's the minimum amount I have to keep in there to keep the fees at zero, or you're going to give me a new toaster or whatever, as opposed to, well, gee, if I'm going to be running most of my paychecks through this institution, let me make sure that they're good with how they handle their money, which would normally be what you would do, but nobody even thinks of doing that now because they think the government's on top of it.
Right.
Yeah, so that's kind of a crazy system. But beyond that, for example, one thing is FDIC in the 2008-2009 fallout, they went underwater. In other words, the FDIC, in shoring up insolvent banks, actually ran out of funds, and they had to go to the Treasury and get a loan just to get, and they did something like they pre-charged, because the FDIC, it's an insurance fund, so they charge premiums to the member banks in order then to pay out when one of them goes bankrupt. And so they had to do something like pre-charge. I think it was 3 years of premium payments just to shore up their finances as they emerge. So there's that element. But beyond that, so these numbers that I'm just going to read here, this was for the book Carlos and I and Nelson had. These numbers were accurate, the latest available. So it refers to the second quarter of 2017. So they might have had the new numbers come out, but this is fairly recent. That at that point, FDIC had $88 billion in funds, sort of backing up checking accounts. That sounds like a lot of money. Wow, $88 billion, that's pretty good. But at that moment, they were insuring $7.1 trillion in deposits. Okay, so the point is that, any one or two banks go under, FDIC can make them whole and you're fine. But if there's a system-wide banking crisis, FDIC has a little bit more than 1% of the funds necessary to bail everybody out. And again, what Dodd-Frank was saying is we're not going to give the general Treasury to be a line of credit for FDIC the way we did in 2008, 2009. So again, the FDIC really is there just in case there's one or two banks that, made bad loans or something. If there's a system-wide crisis, the FDIC is dropping the bucket.
Yeah, I really appreciate going through that because that really ties into this conversation really nicely. And that's really the motivating factor for a lot of people being interested in getting their money out of the bank. So transferring this conversation back over to insurance, let's say, is part of your thesis here that the insurance companies are more reliable in terms of being able to pay out or provide liquidity, et cetera, than banks historically.
Yeah, definitely. So historically, you can see in the Great Depression in the 1930s, thousands of commercial banks failed, whereas the life insurance company or industry was much more stable. And in fact, a lot of people who couldn't access their money because the bank either went down or it closed its doors or whatever, they went to their life insurance company and took out a policy loan or surrendered the policy to get the cash value. And that was a source of funds for them. So yeah, historically, we can say for sure that the life insurance sector rode out or weathered the Great Depression much better than the commercial banking sector did. I would say this time around, or just in general, they're much more conservative, right? So the life insurance sector, they don't have all these generous government programs in place to, bail them out. There's not the analog of the Federal Reserve. I mean, think of what the Federal Reserve is supposed to be. It's a lender of last resort, right? So if you just think about the very nature of the Fed and why it was established, it was basically saying, in case some regular bank gets caught with its pants down, instead of having to shut down, the Fed will come in and rescue it. And so again, that might be good news if you happen to be in the moment in a crisis and you have funds at that one bank. But in general, that's a recipe for recklessness. And again, the very nature of the fractional reserve banking, the way commercial banks work nowadays in our current system, that by their very nature, if people lose confidence, that's it. Right. And so notice that, that's something that's particular to certain financial areas. It's not a general principle that, I don't have to have confidence. Like if I hear my neighbor doesn't like a certain restaurant, I don't care. Whereas if I hear my neighbor's taking his money out of my bank, then I might have to go do it too, just because, I got to beat everybody else. Right. Whereas if somebody doesn't want to go to, some restaurant I love, if my neighbors don't want to go there, that's good. That means I'm going to get seated quicker. Right. So I'm just saying that the nature of commercial banking right now, it's very fickle and prone to just public sentiment or confidence. And so that, again, just underscores how, the very nature, think of it this way, of banking, the way it's practiced nowadays, that they engage in maturity mismatch. That by definition, when you open a checking account, that's instantly demandable funds, and yet they go ahead and lend your money out for much longer terms. So there's a fundamental mismatch in maturity there. Whereas with life insurance, yes, we have done articles, Carlos and I, for the Laura Murphy report, our publication, where we go and look at their reports in terms of their portfolios, and they invest in very conservative things. But beyond that, I'm just saying the nature of what they do is they try to match their liabilities and their assets, because they have liabilities in terms of, this block of policies. We think the people will die like this, according to what the actuaries tell us. So they try to get assets of a similar longevity to try to match those cash flows. Whereas again, commercial banking, when you're looking at checking account deposits, that's, they're saying anytime you show up, you can take out your money, and yet they've lent that money out.
Right. And that's just not the case. I actually bought a used car once in cash for about $9,000. And to get $9,000 out of a bank took all day and 3 banks just to get $9,000 out. And so the cash is not available, which actually brings up a good question. You mentioned the investments that insurance companies make. Obviously, a lot of that money is going to their own company. They want to reinvest in themselves, et cetera. But also they do things like buy government bonds. Do you have an idea of what percentage? So actually, let me restate that. So the major risk, like a similar risk to a bank run, would be if a lot of people died and an immediate payout was needed from an insurance company. I think that risk is kind of mitigated for a variety of reasons. At least if there's a major problem with everyone dying, getting the payouts the least of our concerns. But I think, really the liability is about this cash value. So correct me if I'm not thinking about this correctly. So do you have an idea as to how much cash insurance companies hold as it relates to their cash value? Because the cash value can be redeemed at any time through one of these policy loans. Is that correct?
That is correct. They do have, I think, contractual language in there that, in the event of a lot of requests, I think they could delay honoring it up to like a month or two, I believe. But yes, in terms of a bunch of people showing up and wanting to pull out a lot of their stated cash surrender value or literally surrendering the policy, there could be a cash crunch on the part of the life insurance company if that's what you're asking.
Yeah, I'm just trying to get a sense of, I guess, the percentage. We mentioned the FDIC. Obviously, that's going to be really challenging if even a handful of large banks have a problem. Do you have any data in terms of the insurance companies and their cash on hand versus the cash value to kind of make an apples to apples comparison, even though it's a little bit of a stretch?
I understand the question you're asking. I don't have, what I can say is I do have data on terms of their asset side, and their cash and equivalents. It's 1.1% of their total assets, and short-term investments was 1.5%. The outstanding policy loans, so that's an asset from their point of view, was 3.2%. But yeah, you're asking me like in terms of what could people show up next Tuesday and try to pull out, and how much do they have in really liquid assets to back them? I don't have that number, but keep in mind, not all life insurance is of this form that has, that sort of an option.
Right.
So like for people who had term policies in place, they can't show up and demand a bunch of cash. So there's that element. So I understand what you're asking me. I don't know the number off the top of my head.
Okay. No problem there. And so let's talk about kind of this end of the world type of situation. This is obviously a motivating factor for a lot of individuals. And I want to say end of the world because I think that makes light of something that's obviously, we were really facing something similar when it comes to the banking section in 2008. If the government hadn't stepped in, things would be very different for a lot of these banks. I think a lot of them would have gone under. So, what do you anticipate happening with the insurance side of things in a 2008 type of situation regarding, being able to pay, being able to, meet their promises, et cetera, and when it comes to the banking sector, compared to the banking sector?
Okay, sure. So I'm just looking here at the table that we did for our book. They've got about 8.7% of again, I'm talking here about U.S. life insurer assets and what's called the general account. So if your listeners want to go do research on their own, just be aware the general account is like what's backing up the standard life insurance policies, whereas people who have policies that are like tied to the stock market or something, that the insurance companies might have other assets like with derivatives and things to pay out those things, but those are handled separately. So the assets that are there just to make sure the standard life insurance is in force and can be paid out. That's about 8.7% in U.S. government securities. 48.4% is in corporate bonds. And those are pretty blue chip, real conservative bonds. And then 11.1% is mortgage-backed securities. So for that, it's 70.1% total long-term bonds. And then they've got another 10% or so in mortgages. So that's the way their main assets break down. So it depends what you're comparing it to. So I think definitely if you think there's going to be just a general economic, a bad recession, I think stocks take a hit much more than bonds. Just a general, a company that's in the S&P 500, their stockholders are going to get hit first before they default on their bonds. And so it's, if someone's saying, well, gee, with the relative things like I got my money in a 401k versus life insurance, yeah, I definitely think any scenario that would take down life insurance company is going to knock out most of the other conventional investments first. So having said all that, obviously there could be a really bad crash that even a lot of these conservative blue chip companies default on their bonds, or even the U.S. government defaults. So that could happen. I'm not saying it won't happen, which is why Carlos and I, beyond just starting one or more of these IBC type policies, we also do think people should have gold and silver in literal currency in a vault in your house if you really want to be conservative and have your bases covered. So I definitely do think people should have outside money in case there really isn't a huge catastrophe. But for more moderate economic problems, I think that what the life insurance companies are doing, it's pretty conservative.
Okay, yeah, that's a really important distinction, and I definitely appreciate you being transparent there about the other investments as well. So, I think the key takeaway there is, look, there's economic risks, but in the scheme of things, I guess the amount of pins that would have to come down to really put these insurance companies in a place of challenge or a crunch, it would take most every other option when it comes to banking or investments in particular to really struggle far before the insurance companies. Is that a fair assessment of kind of that statement?
Right, exactly. So yeah, it depends who I'm talking. If I'm talking to somebody who's got bottled water and ammunition in his backyard, or he's living in the mountains and he thinks it's going to be World War III next week, yeah, given his worldview, then he probably doesn't want to do what I'm talking about. But
right.
If someone's just trying to say, oh no, I'm doing what Dave Ramsey tells me to do, and yeah, you're talking about whatever. But you know what? If there's a crash, like you say, well then life insurance goes. That's I'm saying is being silly. That it's a matter of degree, and certainly, like I say, the Great Depression was really bad, and yet thousands of commercial banks went down, but life insurance companies were mostly got through that. So Again, this historically we do see this sector really is much more conservative. And that's part of the flip side. They're not trying to please investors, right? That the standard knock against like a whole life policy is, oh, the rate of return's not very sexy. It's real boring and just kind of chugs along, not doing too much. And I'm saying, right. And the flip side of that is it's very sturdy. That because they're not in exotic things, that they're pretty conservative, and so that's why they would be one of the last dominoes to fall in the event of a major crash.
Right. But there's actually a way to kind of dovetail the security with a somewhat more lucrative return, with the potential for more lucrative returns, which is where this whole policy loan comes in place. So let's talk about this, because I know that this is going to be the intriguing part for a lot of listeners. So once you have put money into your plan, you've built up the cash balance, you can then receive a dividend on that cash balance, and there's also a guaranteed rate. What is the range of these dividends and these guaranteed rates historically, and how can we look up this information from like a historical distribution perspective?
Well, you could go ahead and, again, I'm going to be a little bit vague here because I don't want to, it depends what time period you're looking at, and there's lots of different, depends what the companies are and everything. So and what I would do is I would just, tell your listeners, like, if you found a particular company, you could ask for their, I'm sure they have literature showing specific examples of what the rates were. You got to be careful. So typically with these things, the internal rate of return, if that's the metric you want to use, you're going to be looking at the surrender cash value and how does that increase over time compared to the stream of premium payments that you're putting into the policy. And so, you can use that information to then back out an implied rate of return. One thing I would say, though, is just notice that would be treating the thing like a bond fund or something, whereas technically you still have the life insurance death benefit coverage in there. So there's that element that, notice at any moment, like let's say you take out a policy and you put in $500 premium or something, and then the next month you die and you get whatever, $200,000 death benefit. That's a huge rate of return.
Right.
And so I'm just saying, let's not ever forget that we're talking about life insurance here.
Yes.
And
very
so
fair point.
There's that element. I've seen things that it's like in the 4% in terms of the normal internal rate of return, assuming you don't die as it goes forward. But keep in mind that that's if you do it right, you're not being taxed on that. So depending on your tax bracket, I've seen people argue that you can get something like roughly a 7% return when all is said and done, which, is not great, but it's not abominable. And given all the other elements of it, I think is a pretty good, it's not too shabby. So I would say that people should consider, all of those elements that for one thing, it is guaranteed. So the 7% or the 4% is not necessarily guaranteed, but where that's coming from is they have a guaranteed side. And then if the company does well, then they'll go ahead and give dividends. And so you can just roll those back into your policy, which makes it grow even more. So that's the element. Whereas, so somebody like Dave Ramsey or whatever, if they want to, they can do a quick blog post and say, oh, historically, the internal rate of return on these permanent cash value policies is pretty bad compared to, a mutual fund. Yeah, but the mutual fund, if it's stock-based, can go down 40% in a year, as we saw in 2008. Whereas with these life insurance policies, once your cash value hits a certain level, it can't go down. It can only keep going up. So there's that element as well. So just make sure when you're, comparing this to other types of financial assets, you're doing an apples to apples and realizing that, yes, the rate of return here is modest, but it's probably bigger than some of your listeners may have gathered just from reading, conventional critiques.
Okay, yeah, that's totally fair. And we can just take the 4%, I think, is a reasonable number based on the research that I've done as well. But also when it comes to, comparing to the mutual fund, so this concept of policy loans is really what makes this advantageous. So you invest, or I guess you wouldn't say the invest terminology there, but you have paid your premiums to the point that you have a significant cash value. You're getting your 4% interest rate as a combination of both the dividend and the guaranteed rate. But then you can withdraw, or I guess take a loan with the policy as collateral up to the balance of the cash value. So when you do take a loan, let's say you have $1 million built up in cash value. I know that's a lot of money, but let's just say that for the sake of the example. You want to do something, and my listeners, the case would be that they would want to invest in real estate. When they do take that loan, what is usually the interest rate that they're going to be paying on the loan of that cash value policy loan, for example?
Well, it's contractually spelled out, and it's usually they have some formula like where it's based on some market proxy or index, and then they might add a couple basis points. So I think it's in the 5% range.
Okay, so the key there is that you can basically, it's advantageous to the point of, let's say, 1 point. So you're receiving, or I guess you're receiving a 4% interest rate and you're paying a 5% interest rate. Is that fair?
I think that's probably right in ballpark.
Okay. And do those interest rates typically change, or is that something that is locked in for the duration of the term?
They can readjust, but I think the number sounds artificially high right now, because what happens is, keep in mind, from the life insurance company's point of view, this is a very safe loan. It's the safest loan imaginable that they're giving to you as a policy loan because they're guaranteeing the collateral. It's even safer than treasuries, right? Because Uncle Sam could default. There's a sense in which you can't default on the policy loan. So normal, like back when interest rates were normal, like back, 2000, in the early 2000s or whatever, it wasn't that much higher, in other words. I think what happened is, as interest rates in general came down, these particular rates did not fall proportionally, because I think they were worried about, just getting caught with a bunch of withdrawals. And so they kept the policy loan rate up. But I was saying, as interest rates rise, I think these particular rates will not rise proportionally. So in general, like when Nelson Nash wrote his book, you could get a much more attractive loan as a policy loan than go into a conventional auto lender, for example.
Okay.
So to answer your question, yeah, it's all spelled out in the in your contract, and yes, the rates do periodically reset, but there's there's inertia built into it. So it's not like your loan automatically can jump 5 percentage points overnight. There's a smoothing process. But yeah, if you take out a loan and you're going to be letting it roll for 30 years, they have a mechanism where the interest rate adjusts based on the market conditions.
Okay, that makes sense. I mean, it can change, but like subject to a particular formula, which it'll be plan specific. So let's just go back to that example then. Let's say that you invest, or you have accumulated a cash value of $1 million. That $1 million is earning a 4% interest rate. Then they're loaning you that $1 million at a 5% interest rate, and you can potentially reinvest that capital in a more risky but also more potentially lucrative real estate investment. And that real estate investment, let's say, was making you like a 7% IRR or a 10% IRR. I think where the listeners would be interested is taking advantage of that leverage that you're getting at 5% and then investing at, let's say, 10%. Is that something that your clients have done? Is that something that people are doing frequently with these types of policy loans?
Oh yeah, absolutely. So again, here where Nelson is not telling people, hey, there's a bunch of different assets out there. Some people like real estate, some people like gold, some people like stocks. And I'm telling you to go ahead and invest in life insurance. That is not what Nelson's saying. What he's saying is use this vehicle as like a warehouse for your wealth, a headquarters for your money, if you will, so that when you see a good investment out there, you'll have the means to pounce on it. Whereas in contrast, if you're socking money into a 401k or something, you can't touch the money except with penalties. And so you can't get at your money. So yes, in general, and Nelson even tells stories in his book about how he bought certain parcels of land using policy loans, and the great opportunity that gave him. So, but yes, you're using this as a convenient way to store your dollars, if you will, so that when you want to go buy something, you can go tap this thing and go ahead. One clarification, just so people don't get confused: you're not withdrawing money out of the policy. Your policy is chugging along, doing its thing, and you're just borrowing against it. So that's actually the source of the dollars is not a withdrawal. It's the life insurance company's giving you a loan.
Makes sense. Similar to the home equity line of credit that you mentioned earlier.
Right.
When you are establishing this cash value, how long does it typically take to be able to withdraw, I shouldn't use that term, to borrow money from your cash value?
Oh, so here's something, yeah, I'm glad you asked this. This is something where the conventional understanding of a whole life policy is totally wrong. Like you go read some people, they'll say, oh yeah, you can't even borrow money until year 3. What they have in mind is a plain vanilla whole life policy. The way you set that up, it's true. It takes a while for that cash value to do anything, but that's not how IBC works. And people who go to our websites and find someone who's been trained in this technique, they set it up in a way where the cash value from your first premium payment a big portion of that automatically is available for borrowing. So to answer your question, if it's set up the IBC way, within 30 days of you making your first premium payment, some of that is available immediately as cash.
Okay. All right. And then I guess the next question then, of course, would be how long does it typically take until the cash value is equal to the amount that you've put in to the policy?
I want to say something like 5 years, but again, that's going to depend on the structure. So that a lot of these things depends how you set it up.
Okay. That makes sense.
To give people a realistic ballpark, I would say like 5 years.
And I'm sure that the contracts are going to be varied between companies, et cetera. Each policy, there are multiple pages. You have to look and see, actually that brings up a good question. Who would be the person or the consultant that you would look at a policy with, a third party? Who would be the type of person or the type of job that they would have to review a policy like that, given the complexities and the fact that it's a long-term investment, et cetera?
Well, so again, Carlos and Nelson and I and David Stern set up a training program for financial professionals. So I would say go to infinitebanking.org/finder to find somebody who's been through our training program that knows IBC. So obviously there's plenty of people who understand life insurance in general, but when it comes to being trained and doing it this particular way, I would just say we know we have a training program for that. So at infinitebanking.org/finder is where you would see the graduates of our program. And that's like what they're set up to do. You just, bounce numbers off of them and say, here's my business and, show me something. How would this help me? And that's the kind of thing they could show you.
Okay, cool. And I know that we'd have to run soon. There's just so many questions I have on this topic. And a lot of that has to do with the fact that I am very interested and it's a completely new paradigm for me. And I'm sure for a lot of listeners as well. So I'm sure that one of the major questions that people ask is related to qualified plans, 401ks, Roth IRAs, et cetera. Most of the listeners on this program are intimately knowledgeable about, or at least familiar with the concept of self-directed qualified plans, which allow you to invest in really anything. In my research, the most favorable qualified plan that I have found is the Solo K, the Roth Solo K. And so this is a potentially self-directed retirement account for self-employed individuals, where you can invest up to $55,000 per year in this qualified plan. And because it's a Roth and you're investing in after-tax dollars, the returns, the proceeds are tax-free. How would you compare, or at least what would your thoughts be comparing a Roth Solo K or qualified plans in general to someone that's using the IBC concept as a means for either retirement or insurance, et cetera?
Sure. So I think some of the main differences are that, so in terms of the tax treatment, I think they're largely analogous in that the premium payments you make, it's after-tax dollars. We think for various reasons, even a business owner who wants to use this approach to manage the cash flows for the business, we think it makes more sense for the individual to have the policy and the business is borrowing from the policy or from the individual. So that the premium payments are not tax deductible. So those are after-tax dollars. But then, as long as you do it right, the internal growth of the policy is tax-free. And then in particular, when you die, the named beneficiary, and it could be your estate again, gets that income tax-free. And by the way, and that's not like a tax loophole. That makes sense that, you get in a car accident and a, car company sends you a check for you to get a new car, to get your car repaired. You don't pay income tax on that because it's just making you whole, right? And so by the same token, life insurance is saying, okay, you were an asset, and then when if you die, it's just making the beneficiary whole because of the loss of you. And so that's not some quirk that lobbyists obtained. That makes sense in terms of the tax treatment. Also, policy loans are not taxable income. So that's important for people to remember also, because again, when you borrow money, that's not net income. And so if you structure these things properly, there's a way they can provide a flow of dollars like in your later years, and then you still have a nice healthy chunk to go onto your estate with no income tax liability. So in that respect, they're similar, but I would say that one of the huge differences is, in general, the tax qualified plans have a lot of conditions on there because the whole point is the government's being paternalistic and wants to force you to, quote, save for your retirement. So they don't want you taking the money out when you're 40 and they don't even want you borrowing against it, right? That, lenders cannot, except under certain circumstances, lend you money with your 401k assets as the collateral, or at least without you paying a penalty. So that's the kind of thing. Whereas again, if you're doing one of these whole life policies that you're funding heavily, nobody's looking over your shoulder. No one's telling you can't use it. That's the whole point. Is you're able to use it, and so you're not as dependent on outside lenders. So to me, the independence, the ability to use the thing without penalty right away, I think is one of the big differences. Other than that, typically, I think people who have these things are probably going to be more into the stock market. The way you would show that, using one of these tax qualified investments has a much higher rate of return than these other things over here. Well, that's because they're riskier. So, if somebody wants to take on the extra risk, that's fine. But I would just, say that the nature of these things in general, your Roth IRA probably can drop a lot in a given year if the market crashes. Whereas, again, these things are contractually, they just keep going up.
Right. And just to add to that, because there was a lot of tax-free moving parts there. So I just want to be clear for the listeners. So in a IBC type of account, that 4% that we use as an example is increasing in the plan, the cash value of increasing in the plan, that is tax-free. But if you borrow money from the plan and invest that money, the gains from that invested money is not tax-free. So if you're trying to compare, let's say, a self-directed account, particularly a Roth account, where the entirety is tax-free, you would want to look at a spreadsheet and see what's going on here, because it's not just, let's say, the 5% versus the 14%. The 5% is tax-free versus, let's say, if you were able to achieve a 14 or 10% return in your solo K, the whole 10% would be tax-free. So it really is a matter of looking at a bunch of different scenarios, including the death benefit, and playing with those numbers to find out which one is more advantageous. And I have not been able to do so, convincingly either way, just because it's new to me. But that would be the kind of thing that I would want to do. Is that clear, Bob? Is that kind of your thoughts on that as well? I'm not sure if you've done that or considered that as well.
Okay, yeah, right. So if you're looking at it, just you put some money into a Roth IRA or whatever, and then that's growing, and that's all you just let it sit there. Versus, I'm putting money into an IBC policy and that's growing internally, but then I'm occasionally tapping against it and taking a loan to go do a real estate venture or, whatever, I buy gold coins or something because I think inflation's coming. Right. Unless you were investing in things that were independently also tax advantageous, you would do your normal income tax on whatever those outside investments were.
Okay.
But the growth inside the policy is income tax free.
Right, which is one of the major advantages of the policy, as well as the fact that you get to borrow the money back, which is tax-free as well. Okay, so just to wrap up real quick, I do want to talk about some of the risks before we move on. What do you see as some of the major risks? How can people mess this up in terms of doing the IBC thing incorrectly so that it ends up costing them money or isn't advantageous? Or what are some of your thoughts on that?
Well, sure. And one thing people often bring up is like, what about AIG and all that? So to be clear, what AIG got in trouble for was their, financials speculative investment division that was completely segregated from their standard life insurance. So people who had life insurance, even if AIG hadn't been bailed out, those people, those accounts are segregated, they would have been fine. So just to be clear about that. So it's the risks. So one thing is, I should be clear, if you are going to go down this path, again, I would encourage people to go to one of our trained practitioners, but you want to be careful to do it with a whole life policy, that there's other types of permanent life insurance, things like called universal life and so forth. And for what we're talking about here with IBC, you really just want to use a whole life policy. And so that's one thing I would mention. Also, there are some people that they think it's magic. They think that, I put money in and then I borrow money, and since I'm borrowing against my own policy, I don't have to pay it back because why? If it's my bank, in quotation marks, why do I have to pay myself? So it's not magic. If you borrow heavily against it, then you're not going to have much equity in the thing, and so obviously, that you're not going to have much after 30 years if you're always borrowing against it right away and not paying the thing back. So I would just mention that some people think that they can all of a sudden become rich without having the discipline of living below their means, and obviously that's not true. This is just a place to channel your savings, to put it that way, and it's a very convenient headquarters for your money. But if you're not saving, it's not going to do anything for you. So I would mention that. So the big thing that could happen is you don't want to surrender one of these things, that you want to keep it in force until you die. Because what can have all these great tax advantages and things, that stuff is only applicable if you die with the policy in force. If you surrender it, then at that point, the IRS is going to look and see, did you effectively pull more out than you put in which case you would then owe tax liability on that. So that's the one thing I would say is, just to be clear on that.
Yeah, you want to be careful there. And then maybe even, getting a plan that doesn't make sense for your financial situation. So for example, if you get too much insurance, you will have to eventually surrender the plan if you can't continue to make those payments. But in one of your podcasts, you mentioned that there is some flexibility in that as well, correct? In the sense that you can potentially restructure the plan to make it more favorable for your new financial situation.
Right. So what can happen is, you can have a policy where you owe contractually, like you owe premium payments either for the life of it, or maybe it's paid up at 65. So, there's various options of setting these things up depending on your circumstances. But just because, you're technically on the hook contractually to make premium payments through age 65, let's say, if you've built up a lot of cash value, you can effectively, take out policy loans to pay the premium payment. You're allowed to do stuff like that. So it's very flexible. Mm-hmm. And that's part of what you do want to do. So for example, someone might say, well, gee, right now with interest rates so low, I can get a really good deal, just borrowing from the auto finance company for my new car. Why would I borrow from my life insurance policy or against my life insurance policy? And one of the reasons is peace of mind, that if you have a hiccup, you get laid off, or you just got a lot of expenses and you miss your car payment, if it's a conventional lender, you get too far behind, they're going to come and take your car. Whereas if what you actually did was borrow against your life insurance policy and then pay cash effectively to the dealer, if you fall behind, that just means the amount you owe the life insurance company is growing at interest. No one's coming to take your car because your car is paid free and clear. So there's that element of flexibility. And likewise, again, if you need to make a premium payment, you've got $10,000 in cash value and your premium payment's $1,000, you can certainly just take a loan from the life insurance company to pay your premium until you get back on your feet. So that there's that flexibility in there that's built in. And also people, what they do is what they might call annuitize the policy. So they build up a lot of cash value early in life, and then in their later years, they just draw out policy loans. And so, yeah, it's a growing lien against the cash value. But if the cash value is real big, that's fine. And what I was saying before is those policy loans are not in taxable income because it's a loan. So there's all kinds of elements like that. So what I'm saying is sometimes people see those illustrations and they think it's magic. And then in their own life, they don't stay on top of it and they take out loans and then never pay them back. And then they're surprised to see how little equity they have in the thing.
Right.
You do want to be careful about that and not, bite off more than you can chew. But it is true that if you're heavily funding the thing up front, it doesn't mean you got to out of pocket pay for it down the road because you can just borrow against it.
Yeah. And a lot of this stuff you outlined pretty brilliantly in the IBC best practices. So if anyone is listening to this that really wants to learn more, Bob has created a series with his partner, Carlos Lara, in which they go through, from the beginning, middle, and end of the entire IBC world. Part of it is best practices where they cover these topics. So make sure to just Google that, and we'll also link to it in the show notes page as well. So before we go on, Bob, and allow you to kind of share some of the information in terms of what your company is, et cetera, I'd like to get your perspective on the state of the economy. We've talked a lot about real estate investments in the program, but also in other podcasts as well. Saying, 7%, 12%, 14% returns. What are your thoughts on where we are in the current market cycle and where you see things going in the future? Sure.
So again, I'm an economist. Again, for your listeners, I'm not like in life insurance per se. This is just something that Carlos showed me and I got into it. And then, we helped set up a training program, but I am not in the business of production or anything for life insurance. I'm an economist. I'm at Texas Tech. And I'm what's called an Austrian school economist. And again, we think that central banks operating through the conventional banking sector are what caused the boom-bust cycle that seems to be a pattern in market economies. So I don't think it's just, that's capitalism for you, the fact that you've got these boom periods where everything seems great, and then for some reason there's this huge bust and unemployment spikes. I don't think that's a normal market outcome. I think that's because the Fed, in the U.S. case, floods the market with cheap credit that pushes interest rates artificially low, that gives a signal to entrepreneurs to start long-term investment projects. that really the fundamentals don't support. It's not that the consumers have actually saved more that would provide the real, wherewithal to fund these long-term investments. And so that might give an appearance of prosperity for a few years, but it's consuming the seed corn, if you will, and it leads to an inevitable bust when the banks tighten. So since 2000, and by the way, there were lots of Austrians, including me, who were predicting that we were going to have a bad crash, in 2008, 2009, before it happened. All right. So this isn't just mere theory, like a lot of the stuff we did in real time before other people realized there was a problem. So for this time around, I think that what Bernanke did with QE, the rounds of QE from 2008 onward, didn't really fix the underlying problems in the economy. So I think it just kind of, postponed the adjustment, and the 0% interest rates that we had for 7 years, I think was just the wrong signal. So just like if they made it so that the price of a barrel of crude had been $5 for 7 years, that wouldn't have made us rich. That wouldn't have made it real cheap to drive cars around. They just would have given the wrong price signal to everybody, would have screwed things up. So likewise, to have interest rates, short-term rates be 0% for 7 years, that wasn't actually making investments really cheap to finance. It was just causing the existing level of savings to be allocated improperly and actually encourage people not to save as much. So I think that screwed up the structure of production, and that you saw like the stock market booming during the Obama years when they were running $1 trillion deficits 4 years in a row, doing all sorts of interventions in the energy sector, putting in, Affordable Care Act. So a lot of things that if you're just market friendly, you would think would have been bad. And yet that's going hand in hand with these booming stock markets. So I think it was the Fed that drove a lot of these asset bubbles. And even when it comes to real estate, I know real estate's, there's local markets and things can be different depending on the local conditions, but just at the national level, the home price index, depending on which one you look at, is now back above, where it was at the prior peak. So for people who were concerned that there was a bubble earlier, well, in a sense, we're above where we used to be. And, so the question is, well, do the fundamentals support it? Maybe, maybe not. So the difference is now that the Fed is definitely in a tightening cycle. Even conventional, finance analysts worry about, an inverted yield curve. So it's not inverted yet, but it's getting, pretty flat. And some people are worried that in the not too distant future, the yield curve might invert, which, traditionally has signaled an impending recession. So I think there's various signals in place, and especially armed with my view of Austrian economics, I think that as the Fed continues to raise rates, we are going to have another big recession. And I think a lot of the asset markets are going to crash because I think, again, they were pushed up artificially during all those rounds of QE. So I would just caution people to be really careful and have a backup plan. And, for people making real estate investments, obviously, you can't just go live in a cave. You got to do what you got to do. But for example, if you're making investments where where you need tenants to make the thing work, build in a danger plan or, catastrophe emergency plan, like, well, how long could I go without being able to get a good tenant in there? What if unemployment shoots up to 12%? Things like that.
Yeah. I mean, you touched on just so many data points there. And I think we should definitely have a conversation about that as a whole, because, you're one of the people I respect on this topic. It's definitely what I've dedicated my business towards. But at the same time, you're looking at the long-term trends. And, just to let you know, Bob, my business focuses on mobile home parks and self-storage. And the reason for that has a lot to do with what you're talking about. We invested significantly in multifamily in 2011, 12, and 13, 14, sold a lot of those assets off in 2014. And the mobile home park and self-storage businesses historically have held up quite well, but the key there is that the demand for the product is there. But to your point, the liquidity, the debt cycle is something that doesn't matter about the demand. Sometimes there can be plenty of demand for a product, the debt can be being paid off on a regular basis, but there is no liquidity in the market. You have a problem refinancing or selling, you can have a major challenge. And that's what happened to a lot of people, even though the occupancy levels may be in the 80s in 2008, they had problems refinancing because the debt market just completely dried up. So, Bob, we definitely have to have you come on in the future to discuss that topic in more detail, because I'm really interested in your perspective. I think we'd have an interesting conversation.
Well, that's interesting you bring it up, because that, for example, with the failure of Lehman Brothers, that people were like, oh, they were all the credit default swaps and things that they were, and with those credit default swaps, it actually in a lot of the cases, it wasn't that the actual defaults just piled up and that was the problem. It was more an issue of the counterparties were getting nervous and were demanding more collateral. And that's what sank a lot of these firms. So it's a similar thing to what you're saying. It was more that people were worried about the next step in the thing, and that's what caused everything to dry up, as opposed to, the actual, what you might have conventionally thought. So
right, the underlying demand,
yeah,
which is, you can look at something and look at historical averages and say, okay, well, this is historically quite stable. But when things go south, and I mean really south, those metrics all change. So the knobs which are moving all turn one direction, you can have a major problem. So like I said, definitely love to have you on in the future to discuss that and the interest rates and debt and the business cycle as a whole. So let's definitely make a note to do that.
Sure thing. Yeah. And people, all this stuff, is it time for me to plug my website? Can I do that now?
Just about to let you do it. So let's hear about it. Your firm, what you do, and anything else that listeners may be interested in.
Sure. So I was just going to say all that stuff that what we've been talking about, the infinite banking concept, but then Austrian economics, the business cycle, what are Carl's and my views on, the coming economic crash and what can you do to protect yourself, things like that. All that material it's at laramurphy.com, and it's spelled LARA-Murphy.com because his last name is Lara. So laramurphy.com, we have all that stuff there. And like I say, I'm an economist, but these are materials that we do. Our training program for the public who wants to just go talk to somebody, all that information, I would just point them to laramurphy.com. We've got it all there.
Okay, and we will link to that in the show notes page. Bob, can't thank you enough. Really appreciate it.
All right, thanks for having me. It was fun.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.